Hi, my name is Kayla Walker. I'm doing a financial analysis for Finance 381. When doing my financial analysis, I was looking at 4 different companies. We're going to look at Amedisys, Ford, General Motors, and Lamar. And on the New York Stock Exchange, they're going to be labeled as AMED, F, GM, and LAMR. The first investment we're going to make is a $1 million 6-month loan, and this is something that we looked at the short-term liquidity ratios to decide. And when I did that, I decided that Ford would be the best company to make a short-term loan to. A few of the ratios that I considered when making my choice were the cash ratio, the quick ratio, and the current ratio, and you can see those down here. And then we have Amedisys, Ford, General Motors, and Lamar at the top. These are all 3 of these ratios are ratios that you want to be high. You do want the highest ratio in order to be better than the other companies for the short-term loan. You can see that Ford in the red had the 0.45 for the cash ratio, which is going to be your assets over your liabilities. They had the highest out of all of the companies, and I felt like the cash ratio was the most important ratio out of all 3 of the ratios. For the second ratio, the quick ratio, Amedisys actually came in first with a 0.87. This is going to be your assets minus your inventory over your liability. Even though Amedisys had a higher quick ratio than Ford still had a high number. And again, I felt like their cash ratio being so much higher than everyone else's is what led them to the beginning of my list for the short-term loan. Your current ratio is going to be how fast that the company can pay back the loan, and Lamar actually had a 1.17, which was the highest of all the ratios, but they only had a 0.09 for the cash ratio, and Ford was 4 times higher than that. So that's again why I went with Ford, because they had a better overall pick of all 3 of the ratios together. And this is just showing that this is going to be your cash ratios in orange for each of the companies. This white is going to be the quick ratio, and the blue is going to be the current ratio. And those are all numbers that you want extremely high. And like I said, the orange and the cash ratio was the most important to me. And you can see where Amedisys and Lamar are, again, so low that I didn't feel like they really competed with Ford. And Ford was in the middle for all 3 of the ratios, and I felt like that's what made them the best choice for the short-term loan. The second investment that we're going to make is a $1 million 5-year loan, and this is something that we're going to look at more long-term debt for. And after doing that for all the companies, I decided that General Motors was going to be the best company to make that long-term loan in, and these are some of the ratios I looked at. First ratio I looked at was the time interest on, and this is going to be how many times that the company would be able to pay back their debt. So this is a number that you're going to want to have really high. Immediately when you're looking at this chart, you're going to see Amedisys is down here in the negative, essentially meaning that they wouldn't be able to pay you back, and that just kind of threw them totally out of the options for me of the 4 companies, because if they can't pay you back, why would you make a loan to them? Lamar is down here. It's not low, but it's not quite as high as General Motors and Ford. General Motors is coming in at 11.05, and again, Ford falling right behind with a 9.98. The second ratio that I looked at is the total debt ratio. This is how many of the company's assets are financed by debt. You are going to want this to be a lower number, because you essentially don't want all of the assets in the company financed by debt. Immediately you can see on the chart that Ford and Lamar have extremely high debt ratios in the 50s for both of them. So when you're looking at General Motors, who's again average, you have about a 32, and Amedisys has the lowest with a 14.6, but being that Amedisys had such a bad time interest earned, it again is what took them out of the running for the possibilities to even do the long-term loan. And Ford and General Motors were running neck and neck with the times interest earned, but having Ford being that they have such a high debt ratio is again why I was leaning more towards General Motors. The last thing we're going to look at is the equity multiplier, and this is going to be a percent of the companies that's financed by the debt, which came from stockholder equity. This is something that you do want to be high. Immediately you see that Ford has the highest, General Motors coming in at second. But when I was thinking about Ford having the highest equity multiplier, all I kept going back to was their debt ratio being so extremely high. And I just felt like the General Motors outweighed Ford in all 3 of these ratios. And just an overall look at all the ratios with the companies together. Again, you're going to want your orange and your blue, your times interest earned and your equity multiplier to be the highest, and you're going to want this white to be the lowest. So again, I kind of went with General Motors because they had an average of everything in there, and Ford just getting totally thrown out, and again with Lamar because their debt ratios were so high, and Ametis having the negative time interest earned. I just felt like General Motors was the best overall pick for this. The last investment that we're going to make is actually going to be buying stock in at least one of these companies, but no more than two, which I felt was kind of important because when I was looking at the ratios that I used for these, I felt like I couldn't pick between two companies. So we're going to pick Lamar for this one and General Motors. Just an analysis of the overall companies is what we did in order to look at the best company for this last investment. So first of all, you're going to see that we're doing a profit margin. We're looking at total asset turnover, the ROE, which is return on equity, and an ROA, which is a return on assets. The Ametis is going to be your orange line, which is all the way at the bottom. It had the highest total asset turnover, but being it was at the bottom of the other three ratios, I felt like it couldn't really go into play, and it wasn't really even an option for making an investment in. Second, we're going to look at Ford, which is going to be your purple line, coming in more towards the bottom at the profit margin. It's in the average right here for the total asset turnover, coming in first for the return on equity, and then again more towards the bottom for the return on assets. Being that I could only pick two of these companies, I just felt like General Motors and Lamar just outranked Ford when looking at the overall totals of all three of these ratios. General Motors is going to be in the blue. You're going to see at the profit margin it's actually coming in second, again with the average for the total asset turnover. Still coming in third behind Ford and Lamar with the return on equity, but you're coming in second down here with the return on assets. So I felt like with that and Lamar running close neck and neck with all three of these, or four of these ratios, I just felt like that's why I could pick General Motors and Lamar both to invest in. Lamar is going to be the last one in red. It's trumping over everyone with the profit margin, way up here, almost in the 20s, with everyone else being below 8. You're going to be in the average for the total asset turnover, again, kind of like the other companies. Coming in second, extremely close to General Motors for the return on equity, and then actually coming in first for the return on assets. So again, with those ratios, with General Motors and Lamar running so neck and neck, I felt like it was okay to choose both of these for the last investment to buy so much stock in. So